In aviation, a trap is when everything looks perfectly normal on your instruments, while underneath the surface, a catastrophe is already unfolding. Dividend traps work the exact same way. The yield looks attractive, the history looks reliable, the brand feels familiar until suddenly it vanishes. Take Walgreens Boots Alliance. They paid consecutive dividends for over 90 years. Then the dividend was slashed. Shortly after, the entire payout was completely suspended. So today's question is simple. Were there warning signs before the crash? And more importantly, could those exact same warning signs be flashing in one of your dividend stocks right now? Welcome back to Skies Capital, where we think clearly and invest better. I'm Captain Pierce. Today is day 24 of our 30-day series, and we are going under the cowling of Walgreens Boots Alliance. We aren't here to make a cheap buy or sell call. We're here to run Walgreens through the Captain Stock Scorecard, dissecting cash flow, debt, margins, and structural safety, so you know exactly what dividend risk looks like before the damage is done. Stick with me until the final approach, and I'll show you how to apply this exact scorecard to protect your own portfolio. Pre-flight checks are complete. Throttles forward. Let's go. Let me set the stage with the flight briefing. Walgreens Boots Alliance, ticker WBA, was not some unknown speculative dividend stock. For decades, this was a name income investors associated with reliability. More than 90 years of dividend payments, 47 straight years of dividend growth, dividend aristocrat status, and for years, Walgreens was even part of the Dow Jones Industrial Average. So for many investors, WBA felt like the kind of dividend stock you could put in the core of a portfolio and stop worrying about. But then the chart started telling a different story. January 4th, 2024, Walgreens announced a 48% cut to the quarterly dividend. The payout went from 48 cents per share to 25 cents. Management said the cut was meant to strengthen the balance sheet and improve cash flow. Within weeks, Walgreens was removed from the S&P 500 dividend aristocrats. Then, 12 months later, January 2025, Walgreens suspended the dividend entirely. A payout history of more than 90 years was over, and the stock, it had already been punished. Walgreens finished 2024 down about 64%. So the question is not just what happened to Walgreens. The real question is, were the warning signs already there before the cut? And more importantly, could those same warning signs be flashing in one of your dividend stocks right now? That's what we're going to test today with the Captain's Stock Scorecard, because the goal is not to react after the warning light comes on. The goal is to check the instruments before the damage is done. So let's run Walgreens through the pre-flight checklist. I'm not looking for one single smoking gun. Dividend cuts usually don't happen because of one bad quarter. They happen when several gauges start moving in the wrong direction at the same time. For Walgreens, 6 gauges mattered most: yield, free cash flow, payout coverage, debt, interest coverage, and the business model itself. Warning number 1, the yield was too high to trust. WBA's yield climbed above 7, then 8, then 9%. But that yield was not high because the dividend was growing. It was high because the stock price was falling. That is not income safety. That is the market flashing a master warning light. Warning 2, free cash flow was losing altitude. Free cash flow fell from over $3 billion to about $1.9 billion in 2023, and then came under even more pressure. When free cash flow weakens, the dividend cushion starts disappearing. Warning 3, the payout ratio was telling two different stories. On earnings, the dividend looked manageable, but on free cash flow, coverage was shrinking fast. You have to use the right instrument. Warning 4, debt and acquisitions reduced flexibility. Walgreens pushed deeper into healthcare with Village MD and CareCentrix, but those businesses had not yet proven they could generate enough profit. More leverage meant less room for error. Warning 5, interest coverage was falling. As more cash went toward interest expense, less cash was available for shareholders. Warning 6, the business model was under structural pressure. Lower prescription reimbursements, fading CO-wide revenue, online competition, and staffing costs were not temporary turbulence. They were pressure on the moat. 6 warning lights, all visible. The question is whether investors were checking the instruments or just staring at the yield. Now, let's run Walgreens through Captain's stock scorecard, the same framework we use to separate a safe dividend from one that only looks safe. And to keep this fair, we are reconstructing the view as of August 31st, 2023, using the latest public filings available before the dividend cut. First, the flight plan. Did Walgreens still have a clear business model with a durable competitive advantage? The scorecard says, fail. The retail pharmacy model was under pressure. Reimbursement rates were tightening. COVID-related demand was fading. Labor costs were rising, and the pivot into healthcare services added complexity before it added reliable cash flow. Next, free cash flow trend. Again, fail. Through the latest public filing, free cash flow was already negative. Operating cash flow was about $1.2 billion, while capital spending was about $1.6 billion. That means the business was not producing enough cash after capex to comfortably support the dividend. Then we check the dividend on a free cash flow basis. Another fail. Walgreens paid about $1.2 billion in dividends, while free cash flow was negative, so the payout was no longer being covered by the cash the business was actually producing. Now to the cockpit instruments. Debt and leverage fail. Healthcare acquisitions added debt, cash demands, and execution risk at the exact time the core business was already weakening. Interest expense, warning. Interest costs were rising sharply. More cash was going to lenders, which meant less flexibility for shareholders. Yield check, warning. The yield was rising, but not because the dividend was getting stronger. It was rising because the stock price was falling. That is one of the classic signs of a yield trap. Then, the altitude check. Was return on invested capital stable and above the cost of capital? The scorecard says, fail. Returns were under pressure, and the healthcare expansion had not yet proven it could create value. So the thesis was not improving. It was weakening. Captain's verdict as of August 31st, 2023, fail. Dividend safety was already high risk. Cash coverage had broken. And this is exactly why we run the scorecard. Not to confirm what we already believe, but to catch what we might otherwise miss because of a long dividend history, a famous brand name, or a yield that looks attractive on the surface. Walgreens is in the past, but who shares some of those warning signals today? Before we go through these names, I want to be very clear. This is not a prediction. This is not a short thesis, and this is not a recommendation to buy, sell, or avoid any of these companies. This is a monitoring exercise, the exact kind of pre-flight discipline the Skies Capital Captain's stock scorecard is built for. These are names worth running through the checklist. First, B&G Foods, ticker BGS. This one is already in the high-risk category because the dividend has already been cut, but even after the cut, the yield is still elevated. That tells us the market is not fully convinced the story is fixed. The warning signs are familiar: high leverage, weak earnings and cash flow, and a portfolio that still needs work. That does not automatically mean the next step is another cut, but it does mean the balance sheet and free cash flow need to improve before investors can treat the dividend as truly stable. Second, Conagra Brands, ticker CAG. This is not Walgreens. It is a completely different business, but the warning profile is absolutely worth watching. The yield is high, sitting around 9 to 10%. Growth is weak, debt is still a constraint, and investors are asking whether the dividend remains the best use of cash if the company needs a bigger portfolio reset. That puts CAG in the watch closely category. The key gauge here is simple: free cash flow after debt service and dividends. If that cushion keeps narrowing, the warning light gets brighter. Third, CVS Health, ticker CVS. CVS is the most nuanced name on this list. It shares one important headwind with Walgreens: pharmacy reimbursement pressure. But CVS is not in the same position. The yield is much lower, cash flow coverage is stronger, and the dividend burden is more manageable. That is why CVS is a monitor, not a high-risk call. The issue is not whether CVS looks like Walgreens today. The issue is whether reimbursement pressure, acquisition debt, and a frozen dividend deserve continued monitoring. And that is the real lesson. The scorecard is not there to predict disaster. It is there to tell you which gauges deserve your attention before the warning light comes on. Now, let's balance this out. The goal here is not to make everyone afraid of dividend stocks. Dividends can be powerful, but the key is separating income that is durable from income that only looks attractive because the stock is under pressure. So, what does a safer dividend actually look like? There are 4 things I want to see. First, the dividend should be covered by free cash flow, not just accounting earnings. For most operating companies, I like to see the free cash flow payout ratio comfortably below 70 to 75%. That gives the company room to absorb a weak year, reinvest in the business, and still protect the payout. When free cash flow starts shrinking, that is usually the first warning light. Second, the debt has to be manageable. Debt is not automatically bad, but it has to make sense for the industry, and the company needs enough cash flow to service it comfortably. Interest coverage above 5 times is a good sign of flexibility. It means the business is not handing too much of its cash flow to lenders. The danger comes when debt rises because of acquisitions that do not produce enough cash. That was part of the Walgreens pattern. Third, the business model has to be structurally sound. A durable dividend needs a durable business underneath it. The company should still earn attractive returns, defend market share, and protect pricing power. Cyclical pressure can be manageable. Structural pressure is different. If the moat is eroding, future free cash flow is at risk. And eventually, the dividend follows the free cash flow. Fourth, the yield has to be earned, not manufactured by a falling stock price. This is the big one. A rising yield caused by a collapsing stock price is not automatically an opportunity. It may be the market warning you that the payout is at risk. The safest income does not come from chasing the highest yield. It comes from free cash flow, balance sheet strength, a durable business model, and disciplined capital allocation. Seek yield that comes from tailwinds, not from altitude loss. Let me give you the framework in one clean picture. 3 zones: green, yellow, and red. Use this anytime you're looking at a high yield dividend stock, especially one where the yield looks attractive because the stock has been falling. Green zone means cleared for approach. Free cash flow covers the dividend with room. The payout ratio is below roughly 70%. Debt is reasonable for the industry. Interest coverage is above 5 times. Free cash flow is flat or growing, and the yield is supported by the business, not by distress. That is what durable income usually looks like. Yellow zone means caution. This is where the payout ratio moves into the 70 to 85% range. Debt is elevated or not improving. Interest coverage drops into the 3 to 5 times range. The yield is rising, so you need to ask why. Is the dividend getting stronger, or is the stock price falling? Yellow does not automatically mean sell. It means stop assuming the dividend is safe and start watching the gauges every single quarter. Red zone is pre-cut territory. This is where the payout ratio is above 90% or free cash flow has gone completely negative. Debt is high and rising. Interest coverage is below 3 times. The yield is high because the stock price is collapsing. Free cash flow is declining and the business model is under structural pressure. That is where dividend risk is no longer theoretical. And that is the key lesson from Walgreens. WBA was not flashing just one warning light. It was flashing several at the same time. When that happens, the question is no longer, is the yield attractive? The question becomes, is the dividend still earned by the business, or is the company trying to maintain a reputation it can no longer afford? For REITs, use AFFO instead of free cash flow, but the principle is exactly the same. Cash coverage, balance sheet strength, and business durability come before yield. All right, so let's bring this back to your portfolio. Maybe you own a high yield stock. Maybe it's a pipeline, a REIT, a consumer staples name, or something from today's monitoring list. Here are the 5 questions I'd ask every quarter. Question 1, is cash flow covering the dividend with a margin of safety? For most operating companies, calculate the free cash flow payout ratio. For REITs, use AFFO. For pipelines, use distributable cash flow. If the payout ratio starts moving above 80%, watch closely. If it moves above 90%, run the full scorecard. Question 2, is the yield rising because the price is falling? A high yield is not automatically an opportunity. If the yield is going up because the stock price is going down, diagnose the cause first. Price-driven yield spikes are warnings, not invitations. Question 3, Is debt rising from acquisitions that have not yet produced cash flow? Track the debt trajectory quarter by quarter. If leverage is rising and the acquired businesses are not paying off, that is one of the patterns we saw with Walgreens. Question 4. Is the business model facing structural headwinds? Ask this honestly. Is the pressure cyclical, meaning it can recover when conditions improve, or is it structural, meaning the moat is weakening? Structural pressure changes the entire thesis. Question 5. Is management talking about reassessing capital allocation? When you hear that phrase on an earnings call or see it in a filing, pay close attention. It can mean management is weighing debt reduction, reinvestment, buybacks, and the dividend. 5 questions every single quarter. It does not take long, and it may help you spot the warning lights before the market forces the issue. As we come in on final approach, here's the bottom line for day 24. Walgreens did not collapse overnight. The warning lights were flashing long before the dividend was cut. Declining free cash flow, rising debt, weaker coverage, a yield moving higher because the stock price was falling, and a business model under structural pressure. Those signals were not hidden. They were in the public filings. They were visible. The question was whether investors were checking the right instruments. And that is the lesson. A long dividend history is not a guarantee. It is history, not a forecast. A high yield is not automatically an opportunity. If the yield is rising because the stock price is falling, that may be the market warning you that the payout is at risk, and earnings alone are not enough. If you want to know whether a dividend is truly covered, you have to check the cash flow, the debt, the interest burden, the business model, and whether the yield is being earned or manufactured by a falling price. That is why I built the Captain's Stock Scorecard. It is a simple pre-flight checklist you can run before you buy a stock. And again, every quarter you hold it. It helps you check cash flow coverage, debt and interest pressure, yield trap warning signs, business quality, and thesis status. So if one of your dividend stocks is flashing warning lights, do not ignore the gauges. Run the scorecard. You can get the free Captain's Stock Scorecard at skies-capital.com/captains-checklist. The link is also in the description. And if this helped you think more clearly about dividend risk, please like the video and subscribe to Skies Capital. It helps us reach more long-term investors who want to ignore the noise, check the instruments, and invest better. Remember, turbulence is not a change in flight plan. This has been Captain Pierce with Skies Capital. Think clearly, invest better, keep the blue side up, and safe skies.